Here's what break-even analysis is one of the most important things that we're going to cover in this course. And it tells you when your company is going to stop losing money and start making money. Talk about break-even analysis. Let's talk, what is it, why is it important, and how is it done? You need to remember the break-even analysis. You're going to have to remember the formula, and this is probably one of the few formulas that you'll have to remember in this course. Formula is going to give you break-even in quantity. Is how many units do you have to sell to get to break-even? If it's fixed cost, and you divide it by the price of one unit minus the variable cost of one unit. So let's suppose we had a fixed cost of $10 and we had something we were selling for $2 and the variable cost was $1. We'd need to sell 10 of those units to be able to get to break even. That's in its simplest form. Business plan, what you really need to do is figure out how long you get to your break even, because lots of times how much money you have before your money runs out, will I get to break even? Break even also talks about at some point, is it going to work or not? Make your decision before you start spending your money. Here we go, losses until break even, plus your one-time startup costs equal total funds required. Let me tell you what that means. Let's suppose you're losing $1,000 a month. And it's going to take you 6 months to break even. You need $6,000. Plus, let's suppose it costs you $10,000 to get your business started. You need the $10,000 plus the $6,000, so you really need $16,000. If you don't have the $16,000, of course, you can't start your business. So here's break-even analysis. Now, a good question to give you on your midterm exam would just give you the chart and tell you to label each one of those. Your total revenue, you see this top line, total revenue, it comes down. You have zero revenue, but you still have your loss because you have fixed costs, right? The break even is when there's no loss and there's no profit. If you look at the blue line, if you're not selling anything, you don't have a variable cost. The blue line, variable cost. Now, all of a sudden, our total revenue, and so we have the difference between our total revenue and variable cost is our profit. So below break even, we have a loss. Above break even, we have a profit. So let's talk about the impact of the changes. If my fixed cost is $10, I'm going to need, and I told you, price of what, let's suppose my fixed cost is $10 and my price of one unit is $2, my variable cost is $1. I have something called a contribution margin. I got $1 going towards fixed costs every time I sell a unit. If my fixed cost is $10, I need to sell 10 units. Well, what happens if my fixed cost goes up to $12? What impact does it have to sales? First of all, I need more units sold, so my break even goes up. If on the other hand, I cut my fixed cost to $8, now I only need 8, so my price goes down. Fixed cost has a dramatic impact on your business operation. It's performed on a monthly basis. Most times you don't have one product, you have two products. And the thing, and we'll talk more about this later, but you have to remember, if you have two products, each product, $10 in overhead, each carries their own portion. And I'll show you more about that. What we're going to do, and here's what we're going to do, is that we're going to build a pro forma. And pro forma, the reason we build a pro forma, from the first month, we work out the calculations for the first month, and we can figure from that, what does it take for us to get to break even? Now, all along, I'm going to tell you 6 months. We're going to assume 6 months. If someone tells you, tries to get you invested in something and says it's going to break even in the first month, I think they're being unrealistic if it's a brand new startup company. So Boudreaux's alligators, we're going to figure out its pro forma. We have to say, How much money do we think Boudreaux is going to bring in that first month? What's going to be his cost, his variable cost? What's going to be his fixed cost? And how much money does he need for the one-time startup cost? That's how you would build his pro forma. You calculate his first month's figure. You determine break even. We would assume he's going to break even in the 6 months. You scale it. You know what his revenue would be from the first month. You know what it would have to be in the 6th month, and you just scale it up to meet the 6 months. And then from 7th month to 12th month, he's got traction, and you continue to increase it from there. We have to calculate the first month's figures, and it says fixed costs. What are they going to be? What's the one-time startup cost? How many? Cost per unit? All these questions have to be answered. We use something called SWAG. Has any of your instructors used SWAG before? It's scientific wild ass guess, because we're guessing how many alligators. We don't know how many alligators, but what we want to do is we assume Boudreaux has experience catching alligators, and that what we would do, one of the things that we had bought is the bio of the person putting together the company, because the bio is Boudreaux is going to say, I've been hunting alligators forever. I know how many I'm going to catch. Calculate the first. We need, what's the fixed cost going to be? What's the one-time startup cost going to be? How many alligators is he going to catch at a cost per unit? And I explained to you why 6 months, because we wanted to give him time to get the traction. Go from 1 month to 6 months. Why? How much? Well, we know if he catches one alligator the first month and the 6th month, we might go 1 and 1 and 1 and 1. But if we're catching 1 and we're going to 25, then we just use a wild guess. We say 2 to 4 to 7 to 8 to 15 to 24. But we ramp it up to that first month. After that, what you'll do in your company that you'll build, you'll assume growth is going to get rapid from after the 7th month on. You've got traction, business starts to grow, and away you go. So this is what I gave you, folks. Here's what you would get. This is what you'll get on your midterm. You're going to get a Boudreaux's alligators. Boudreaux to start an alligator business. He calls it Boudreaux's alligators. He'll have to buy 5 boats and all equipment necessary to hunt alligators. He estimates the cost for the equipment would be $250,000. Licenses and everything else would be around $70,000. These costs would include setting a warehouse up where he'll process the alligator catches. Now, what do you think this is called? Does he have to pay this every month? See, this is a one-time setup cost, right? That's what it costs him to get in business. Now, Boudreaux thinks he'll be able to sell the meat and skin from the alligators he catches. He thinks he's going to have 5 boats. He thinks each boat will catch 2 alligators per day during the first month. He feels he'll be able to hunt alligators on an average of 20 days per month. And thinks his alligator's going to average 300 pounds and 6 feet in length. He says the alligator buyers usually pay $1.50 per pound for alligator meat. But even though it weighs 300 pounds, he only gets 40 pounds per alligator. And he gets $9 per foot for alligator skin. The cost for processing the alligator meat is 40%, and the alligator skins is 60%. These costs include the labor for catching the alligators. So here's what we know. This is the problem that we have. So here we know his one-time startup costs are $250,000 and $70,000. He says he's able to catch the skin is going to get $9 a foot for the skin. He's going to get $1.50 a pound for the meat. So every time some alligators are going to be big, some are going to be small. But what he thinks that he'll be able to do is he'll be able to average 40 pounds and 6 feet in length, and he'll go from there. The other thing, he's got his expenses. These are his fixed costs. He's going to pay himself a salary, warehouse manager, warehouse assistant. Oh, by the way, he's got some truck gasoline expenses, a warehouse rental, telephone, cable, and TVs. Boudreaux's brother-in-law, Hebert, has offered to provide the funds necessary for Boudreaux to start his alligator business. He said he told Boudreaux this offers a one-time shot. Don't come back and ask money for me later. Tell me how. Boudreaux says, I want you a one-time shot. Tell me how much money you need. We'll take it from there. What we need to know is what's the minimum amount of money Boudreaux needs to start Boudreaux's alligators. Now, we know he's going to have losses. So we got to figure out how much losses is he going to have until he gets to break even in 6 months. And to that amount, we have to add the one-time startup expense. Let's see what we can do. That's all information we have. And from that, we come up with break even, and we can do a pro forma. So what you'll be doing now, once again, but what we'll do is we'll rapidly turn this into an online company. Now, your research project is to do research on affiliate marketing fees. The company that we're building, and I know some of you have done startup companies and other courses. We're not doing that. When you're doing the final product you're going to do, the final project, you're going to build a business plan for starting a 100% online company whose only source of revenues will be from affiliate marketing fees. So that's why you're doing this research report for midterm. What is affiliate marketing fees? How do you make them? Because that's what you're going to be setting up the end of the semester class on. You're going to set up a company that has 100% revenue from affiliate marketing fees, and it's 100% online. Now, last semester, I probably had 25% of my class that got a 0 on the final project because they just took one of their canned projects they used for another class and turned it in, and they got zeros. And 0 out of 150 was a pretty tough. So though we're doing the bricks and mortar here with Boudreaux's, I'm showing you how it works for a traditional company, and then we'll rapidly turn it into an online company. So here's our problems that Boudreaux has. How much money does he need to get it started? When's he going to make a profit? And how much revenue will he need to lease us? How many units will he have to sell, and how much profit will we have to make? This is what the pro forma looks like. Now, I sent this to you, and if you see the little red marks here on the side, see the little red marks on each side, what that does, if you click on it, I sent it to you in an Excel format. If you click on it, it tells you exactly how to do it. And so it should be an easy process. It'll tell you exactly how to do it. All right, so what we're going to do real quick, I'm going to show you how we do this. And then what we'll do on Tuesday of next week, we'll come back and we'll do it again in class and answer any questions that you might have. So let me do this. Let me stop sharing that one. Okay, I'm blowing this up big enough so everyone can see. First of all, what we need to do is we need to know how many alligators will he catch. What we're doing, I'm pulling up, I don't know if you can see it on the side. You probably can't see it, but I'm pulling up my file that shows me what Boudreaux says. Now, what Boudreaux says, and you're going to have to show me all formulas, because if you don't show me a formula, I'm not going to give you credit. So Boudreaux has 5 boats, right? And he says he's going to catch, each boat's going to catch 2 alligators per day. And he says, Boudreaux says, he can catch, let's go back up here and see if so what Boudreaux said was, we can see the formula up here is too small for you to see. But it says, let me do this. Let's go back and let me do it again. We said, Boudreaux has 5 boats. He catches 2 alligators per day times he can fish 20 days. So this is our formula. Now, so often you'll forget how you did the formula. That's why how you came up with a number. That's why you need to put the formula in there. And I want to see it. I'm not going to give you credit if you don't have the formula. What we know is Boudreaux is estimating he can catch 200 alligators per day. What we know is alligator meat, number of units sold, this is an example you're selling. Here's what we know. We're going to get the meat we're going to get. How much meat are we going to get from this? We're going to get 40 pounds per alligator. Alligator in skins, we're going to get 6 feet. So what we say here is that if we take our 200 alligators times 40 pounds, we're going to get 8,000 pounds of meat. If we look at we have 200 alligators times 6 feet of skins, we'll get 1,200. So what we've done with the information that Boudreaux has given us, we figured out, one, how many alligators he's going to catch. From that, because he estimated 40 pounds, and he estimated 6 feet, we know he's going to have 8,000. So now we've got these units so we can figure out his revenue. So what we would do is alligator meat, what did we say? We said it was going to sell for $140, right? And we said alligator skin is going to sell for $9 a foot, right? So what we want to do is calculate our revenues. We'll go 8,000 pounds of meat times $1.40, and then we say $9, we're getting 1,200 feet of skins times $9. And if we sum those up, we know our revenues. Let me do this. We now have $22,000 in revenues. So remember what we said in the last one I gave you the PowerPoint slide. First thing we had to do was calculate revenues. So we now know Boudreaux in his first month can create $22,000 in revenue. Variable cost in meat, he told us his variable cost in meat was going to be 40%. His variable cost in alligator skin was going to be 50%. Now let's talk about what that means. That means that he takes an alligator over to this place to have it processed. They process it, and to process it, they're going to charge him 40% of what his sales costs. In this case, what we're going to say is he's got $11,200 in revenues times 0.4 or 40% is $4,480. It's going to cost him to get the alligator skin processed. Then he says the skin is going to cost 50%. So he has $10,000 but times 50%. And if we sum those two together, we see his expenses are $9,880, his variable cost. And so if we look for operating revenues, we had $22,000 minus his variable costs. He now has $12,120. So what we did, up here we calculated his revenues. Here we calculated his variable costs. And now this is the money he's got against his fixed costs. So we look at his salaries. Now he said he was going to pay himself $9,500. He was going to pay his warehouse manager $3,500. And we said he was going to pay his warehouse assistant $2,500. All right. So that was $15,000. His warehouse rent was going to be $4,000. And his truck expenses were $2,500. And he was going to spend $1,000. If we sum those up, what we know is he's got $23,000 in monthly expenses. First thing that we notice, what do we notice? Okay, what's the first thing we notice here? If his total fixed costs are 23,000, in other words, if I say I take my operating revenues of 12,000 minus my fixed costs, I've got a loss right now of $10,880. As we go down his one-time setup costs, machinery and equipment, he said 250,000. He said other expenses, what did he say, 70,000. Total expenses at this point, 320,000. So at this point in time, Hannah, what's the minimal amount he needs to ask after the first month? What's the minimum amount he would ask his brother for, his cousin, or Boudreaux's cousin? What would he have to ask Hebert for?
Because that's just
what about the $10,000 he lost that month?
Oh, well, he would add that to it. So
So what I need right now from Boudreaux, I needed 320,000, right? And I have to put minus the minus. So at this point, the bare minimum he would need at the end of the first month would be $330,880, right? Now, will he need that $320,000 next month? No, because it's a one-time startup cost. So you see what we have here, we figured out the revenues, we figured out the variable costs, we did the fixed cost, and now we looked at the one-time setup costs, and we found our net operating income. This is exactly the sheet I gave you. This is what you will receive. I'll hand this to you, and I'll give you a blank sheet with a template. This is what you'll receive, and it's going to be worth 100 points. The numbers will be changed, but it'll be just like this. And what you'll have to do is calculate revenues, variable costs, fixed costs, break even, and a minimum amount that Boudreaux will need after the first month. This will be on your midterm. This is a major part. On the first day, we won't cover, we're going to do a pro forma on the 24th. On the 22nd, we'll have a short word essay that you'll have short 5 or 6 questions that will require short answers. All right? That's how important I think this is. This is exactly what we're going to do. Now, what we'll do in class on Tuesday is that we'll take this and we'll extend this, and I'll show you how break even. And what we do in break even is we put the number I won't require. All I'll require on a midterm exam is you'll build this, you'll need the minimum amount of cash you'll need, and you'll have to do the break-even analysis to show in alligator skin how many units will be required for him to get to break-even. Go ahead and do the break-even analysis. Well, the first thing we know, and remember, we've got 2 products. So we've got a fixed cost of $23,000. And what we know is that we've got $23,000 in fixed costs. Now, alligator meat is going to carry some of that fixed cost, and alligator skin is going to carry the rest. So the question becomes, is that what percentage is each going to do? So we look at alligator meat first. To find out the percentage we would do, we would go back to sales revenue. and we say alligator meat is 4,480 divided by total sales, and then we would do the same thing, and I'm going to change this a second, plus alligator skins divided by total revenue. And so what we do here, we're going to change this to percentages. And we'll see that 45% of your revenue comes from meat and 55. Now, when you calculate these, they got to total up to 100%. And if they don't, you made a mistake. So now what we know is that the fixed cost is 23,000. We multiply it times 45%. If we go to 23,000 times 45%, we know that 10,000 of the fixed cost is covered by the meat, and then we take the 23,000 times the 55%, and we know it's covered by the skin. And the total of the two has got to add up to 23,000, because if it doesn't, you made a mistake. So now what we need to know is how many units. Remember, we go back to our formula. Fixed cost divided by the price of one unit minus the variable cost of one unit, right? So here's what we have to do. We know our fixed cost is 10,400. We divide it by the variable cost. Now, by the sales price of one unit. Now, what's on meat? What's the sales price of one unit? Hannah, what's the sales price of one unit? Hannah, turn your mic on.
It was, I can't see it right now. It's $1.40.
Okay, so we're $1.40, Hannah. So we know it would be 140, right? Minus the variable cost. Now, what's the variable cost? Let's see who else is just anxious to answer my question. Sean, what is the variable cost?
I'm not sure.
Okay, well, the variable cost of the meat is 40%, right? But so what we do is we do 140. Well, let's go. What we do is we do a bracket, and we say 140 times 0.4, right? And then we put another bracket to cover it all up. So we have 12,416 pounds of meat necessary to get to break even. All right, and I'm going to come back and redo this in a second. So what we do now, we do the same thing here. We say we have a variable cost, a fixed cost of 12,571. All right, Joseph, turn your mic on. All right, so Joseph, what's the sales price of alligator skin?
$9 per foot.
Okay, $9. Okay. So we know it's 9. That's the sales price, right? So we need the sales price of 1 unit, 9, minus what's the variable cost of 1 unit? Joseph?
It'd be 55% of $9.
Right. So I do, once again, I do $9 times 0.55. No, not 55. What would it be?
Oh, it'd be 50%.
50%, right. So we know we need 12,416 units of meat, and we know we need 2,794. What do we need in sales dollars? Joseph, what do we need in sales dollars?
Would it just be, I don't know.
We would say 1,246. What does that meat sell for?
$1.40 per pound.
Okay, times $1.40. Okay, now what do we know that the skin sell for?
$9.
Okay, so we say times, no, wait, I'm sorry, plus times 9, no, I'm sorry. We sum it up. So we say, if we get around $42,000 in sales, right, then we're at break even. Now, here's the neat thing about doing it in a spreadsheet. I've got all the formulas here, right? So I can go over here, I can copy this, right? And all I have to do now is I go up to my 6 month plus, I know how many units I'm gonna have, right? All right, and then I go back and I know how many, wait, I put the wrong number in. This is really, and guess what? I broke even, right? So what I know is that I had start off with 8,000. I need to get to 12,000. I start off with 1,200 and I need to get here. So what I say is, let's suppose I go to 9,000. Let's suppose here I go to 9,800. Let's suppose here I go to 10,000. And here I go to 11,000. And here I say I went from 1,200 to 1,800 to 2,000 to 2,200 to 2,500. And guess what I have? I have a 6 month pro forma, right? And the way what I have to do though, is that my net operating income is, and I say that my one-time minimum cash requirements, I need 330,880, but I need 338,880 plus the 73, right? Now I have to do minus to get it to go back to a positive number. But now, after the second month, I need 338,000. After the third month, I still lost 5,000, right? After the fourth month, I lost 4,700. And after the fifth month, I lost 2,500. So what we know right now, Boudreaux needs to ask Hebert for $351,198. And if he doesn't get 351,198, he can't start the business, because if he's made these projections and he believes in these projections, then his problem is real simple. He's going to run out of money before he gets to break even. So that's what we're going to do. Now, for the midterm exam, you're going to calculate the first months, you're going to calculate break even, and give me units and sales dollars. That's all you're going to do. But all I'm going to give you is that one sheet. I'm going to give you a blank spreadsheet with all this information on it. It's going to have different, it might be 9 feet, it might be 30 pounds, it might be $1.50, it might be $7. But you're going to have to calculate this portfolio. So this is how you do it. When you're starting a business of any type, you can estimate, if I just say, estimate the first month. Tell me what you think you can do in the first month. And because you know the business you're going in, you've researched the business, you come up with an idea of how many you're going to do in the first month. And then from there, we calculate 6 months, we calculate the losses you'll incur up to 6 months, and away you'll go. Now, the online company that you're going to, that you'll be dealing with online, that you're going to set up online, we're going to assume that you pay yourself $50 an hour, and you're going to spend 48 hours a month doing it. And so that means you're spending a little over 10 hours a week on it, right? And so that you're going to pay yourself $50 an hour, and you're going to have losses up to the 6 months, but the real loss is you won't be able to pay yourself. It won't be any money out of pocket. But in this case with Boudreaux, if Boudreaux doesn't get this, if he doesn't get this full amount, this 351,198, he can't start the business. When you ask someone for money, when you ask investors for money, one of the key questions are, what are you going to do with it? Well, you pro forma, Boudreaux showing him what he's going to do with it. I'm going to have these losses, and if we wanted to sum them up, let's suppose we just did a thing down with it so I can get to this. Let's suppose we wanted to sum up Boudreaux says he lost $31,198, right? So he needs that 31,000 plus that 320. And that's he's showing him exactly what he needs the money for and how he's going to use it. Because when you raise money, if you see the Shark Tank and you go on the Shark Tank and they give you money, none of that money is going in your pocket. They want to know what you're going to use the money for, how you're going to use it, and the way it's going to be spent. None of that goes in your pocket. Questions? Yeah. All right.
I have a question real quick.
Okay.
You know, I know I probably won't
Who's this?
apply to Logan.
Okay, Logan.
I know this probably won't apply to test, but for this specific business, I know that there's variable market pricing as far as meat goes. How do you factor those types of things into your break-even analysis?
Okay, I'm Boudreaux. Okay, let's suppose I'm Boudreaux. Boudreaux has been catching alligators and selling alligators for years, right? And so Boudreaux knows, let's suppose I did this as a crawfish farm. Every crawfish farmer in the world has gone up and down with prices. They catch it. Man, if I'm catching lots of crawfish at Easter time, I'm wealthy. I catch a bunch of crawfish in May when they're hard. Nobody wants them, right? So what we're doing is, I'm an investor. I believe that Boudreaux knows the business, Logan. And Boudreaux comes up with that 40 pounds. And Boudreaux says 6 feet. From his vast experience catching alligators, he says this is going to be the average amount of processed meat you're going to get, and this is going to be the average left. And that he says, and this is, et cetera, et cetera. Now, I just threw these numbers out there, crazy numbers. Now, you know Boudreaux's not going to need 320,000 to set up an alligator. But I wanted to just throw numbers out there to see. But Logan, when we talk about the swag, see, even Boudreaux that knew the business, or you're a crawfish farmer, when I tell you 6 months from now how much you catch it, that's overwhelming. But if I say, just in the very first month, what are you going to catch? Now, Logan, would you expect to catch the exact same amount if you got experience in the first month? You're going to have a lot more experience 6 months down the line. You're going to be catching more. So we come up with the first month, we project out from there. And you know that if you, when I showed you success, like a hockey stick, they want to see that rapid rise. Early on, the first 6 months, you're getting traction. But man, after that first 6 months, what investors want to see is the sky's the limit. And if then can you scale it? They talk about scaling it. Can you get it rapidly going up? And if you can't scale it, they don't want to hear about it. Good question, Logan. Anybody else have a question? See, that question of how many pounds, what's the price, this goes back to you're investing in the person because you believe Boudreaux knows the business, because you don't know the business. Now, one of the worst things you can ever tell an investor is that, well, if it doesn't work, you can have the business. I don't want the business. I'm investing in Boudreaux. What do I have if Boudreaux walks away? I don't have anything. I got 5 boats in a warehouse or whatever. So don't ever say, well, if it doesn't work, you can have the business. I don't want it. I'm investing in you. What I'd like you to do, I'd like you to have your spreadsheet pulled up on the screen so that when we meet on Tuesday, you will go through it step by step by step. Now, what I will do is that I will come to you and say, how do we calculate how many alligators he caught? And I will say, Sean, you do this, Handy, you do this, Logan, you do this, and away you go. And we only have 2 days to cover this. Well, 3 today, Tuesday, and Thursday. And by that time, you need to know it inside out. You need to know the impact of fixed costs, sales price per unit, variable cost per unit. I know, for example, if my fixed costs stay the same and my sales price, I'm able to sell it for more and variable costs stay the same, I need fewer units. On the other hand, if my sales price stays the same, variable cost stays the same, and my fixed cost goes up, I need more units. So I'm going to post a copy of this class on the front of the your Moodle website. You'll be able to look at it, but I also sent you copies of all these files. You need to spend some time working on them and come with your questions on Tuesday so that we work it on Tuesday. We'll come back and work it again on Thursday, but then I'll see you in class on the following Tuesday. That's the 22nd. And I'll see you in the class the following Thursday. And it won't be in place to hide. This is really important. You won't leave college with anything more important than understanding the break-even analysis and how to do a pro forma. And everybody talks about on the back of the napkin they calculated or on the back of an envelope. What they're doing is this is what they did. So what does it take to get to break even? How long does it take to get there? How much money we're going to need? And so For a small entrepreneur, the perform is used mostly for your own personal management tool. And that what you really want to do is that if you don't get there in 6 months, take a deep, dark look at yourself and say, do I keep pushing along? Do I let it go? Do I pivot and move on? So that's the importance of this. Any questions before we close it down for the day? All right, if we're gonna call, this is in the class, we're gonna finish up the class now. And what we'll do is that if you have any questions, you can stay after class and I'll be glad to answer the questions. If not, I'll see you on Tuesday. Please try and have it loaded on your machine. Go look at the little orange highlights. It tells you how to do it. The numbers might be different on the orange highlights, but it tells you step by step what you have to do. So if you load that on, you look at it, we go in and do it on Tuesday, we come back and repeat it on Thursday, the following Tuesday, you should be ready. Questions?